The $100,000 prop firm account you are trading does not exist. It is a psychological anchor designed to make you miscalculate risk. The reality of the retail prop firm industry is not built on funding successful traders. It is built on a mathematically optimized model where your failure is the primary revenue stream. Data shows that the prop trading industry reached a staggering $2.5 billion valuation in 2023. Platforms like Funded Next and FTMO pull in over 4 million monthly visits each. Yet, underlying this massive expansion is a brutal financial architecture. Roughly 70% of a traditional prop firm's revenue does not come from profit splits in the real market. It comes directly from the registration and reset fees paid by traders who fail the evaluation phases. This is the B-book model, a business structure where the platform's mathematical survival depends on your statistical ruin. If you look at the raw statistics, only 5% to 15% of candidates pass the initial evaluation phase. Earn to Trade reports a pass rate of just 10.42%. E8 funding sits around 8%. But it gets worse. A comprehensive study on over 6,900 registered accounts showed that while 5.7% managed to reach a funded stage, only a tiny 1.18% actually achieved at least one single payout. The house is winning because they have weaponized mathematics against human psychology. To beat them, you must stop trading like a market spectator and start treating their rules as a pure mathematical optimization problem. Today, we break down the exact mathematical blueprint to reverse the edge and exploit the system. To beat the system, you must first strip away the nominal illusion. When a prop firm grants you access to a virtual $100,000 account with a maximum drawdown limit of $10,000, your brain instinctively calculates risk based on the six-figure number. This is a fatal cognitive bias known as the leverage illusion. Mathematically, your operating capital is not $100,000. Your operating capital is exactly $10,000. The distance between your starting balance and absolute liquidation. If you risk a seemingly conservative 1% of the nominal balance on a trade, you are risking $1,000, but $1,000 relative to your true liquidation capital of $10,000 is actually a massive 10% risk. By forcing a high nominal target, say 10% or $10,000, relative to a tightly bounded drawdown, the firm creates an asymmetrical playground. They are forcing you to double your real operational capital while allowing you only a fraction of the structural errors a real macro fund would tolerate. This distortion dramatically compresses the number of consecutive losses your system can survive before mathematical ruin. The survival of an algorithmic or discretionary strategy within these rules depends heavily on a concept called path dependency. It is not just about where your equity ends up, it is about every single tick and fluctuation it takes to get there. Prop firms implement 4 primary drawdown architectures, each scaling drastically in statistical severity. First, we have the static drawdown. This is the most mathematically favorable model. The liquidation floor is permanently anchored to your starting balance. If you start at $100,000 with a 10% limit, your floor is fixed at $90,000. Any profit you build increases your buffer, expanding your operational playground and lowering your risk of ruin. Second is the trailing end-of-day drawdown. Here, the liquidation floor moves up only when your daily closing equity hits a new peak. It ignores intraday volatility, but locks in gains at the end of the session, meaning your safety buffer cannot expand past the initial parameters relative to your peak closed balance. Third, and by far the most toxic mechanism engineered by firms, is the trailing intraday drawdown. In a trailing intraday model, the liquidation floor is calculated tick by tick based on your maximum unrealized equity peak. It moves up in real time, but it never moves down. Let us look at a real scenario. A $50,000 account with a $2,500 trailing intraday drawdown. Your initial floor is $47,500. You enter a position. The trade moves heavily into profit, reaching positive $2,500 open equity. Because your peak equity touched $52,500, the intraday mechanism instantly drags your liquidation floor up by $2,500. setting it exactly at $50,000. If that trade retraces due to market volatility and closes at exact break-even, your account balance is still $50,000. But your liquidation floor is now also $50,000. Your account is instantly terminated. You are disqualified without ever realizing an actual monetary loss on your balance. This is the unrealized profit trap, an asymmetrical rule designed to kill trend-following systems. To beat this asymmetric matrix, your strategy must possess a strictly positive expected value after transaction costs. But a positive expected value is only a baseline requirement. The real killer in prop evaluations is the risk of ruin. The classical risk of ruin equation demonstrates that your probability of hitting a liquidation threshold changes exponentially based on two factors: your risk per trade and your win rate. When we run 5,000 Monte Carlo path simulations across different strategy archetypes subjected to prop firm drawdown constraints, a clear mathematical truth emerges.
High-reward, low-win rate strategies, such as trend-following systems looking for massive 20-to-1 risk-to-reward ratios, face a severe mathematical penalty here. Why? Because a 20-to-1 system inherently features long, extended strings of consecutive losses. In a standard account, your capital can weather a streak of 10 losses. In a prop firm account, because your real operating capital is tightly restricted to the drawdown limit, a standard statistical distribution of consecutive losses will hit the drawdown floor long before the massive winning trade ever materializes. The Monte Carlo simulations identify an exact statistical sweet spot for prop evaluations. By dropping your nominal risk per trade down to 0.50%, the probability of hitting a maximum drawdown threshold collapses towards zero exponentially. Furthermore, the data proves that under trailing drawdown conditions, the probability of failure triples compared to static environments for the exact same strategy. This means your operational parameters cannot remain static. They must adapt dynamically to the path dependency of the rules.
This brings us to the core execution protocol, a 5-step mathematical framework engineered to systematically strip the house edge from the prop firm model. Never calculate your lot sizes based on the account's nominal value. Your baseline position sizing must be derived entirely from your real operational capital, the maximum drawdown floor. If you are trading a $100,000 account with a $10,000 static drawdown and your risk model dictates a 2% risk allocation, your trade risk is 2% of $10,000, which is $200 per trade, not 2% of $100,000. As your equity curve approaches the firm's profit target, your risk must scale down, not up. If you need an 8% profit target to pass and you have achieved 6%, you are mathematically in a position of asymmetry. You only need 2% to pass, but you are still a full 6% away from liquidation. By reducing your nominal risk per trade by 50% at this checkpoint, you compress your volatility footprint, ensuring that a late-stage sequence of negative variance cannot drag you back into the deep drawdown zone.
Many modern firms implement consistency rules, requiring that no single trading day accounts for more than a specific percentage of your total profit targets. To neutralize this mathematically, implement a strict daily profit cap. The moment your algorithmic or manual session hits a pre-calculated net return, all execution must cease. You are preventing a hyper-profitable outlier day from forcing you to trade extra days under unnecessary market exposure just to satisfy an artificial consistency metric. If you are forced to trade within a trailing intraday drawdown environment, you must compress your profit targets. Because open, unrealized profit drags your liquidation floor upward. Leaving trades open to experience massive wicks and retracements is mathematical suicide. Your strategy must shift toward highly mechanized, high-frequency targets where positions are liquidated rapidly near key structural levels. You must consciously trade open profit potential in exchange for protecting your absolute drawdown floor.
The final step is purely financial. Mathematically, purchasing a prop firm evaluation is not an investment in an asset. It is the purchase of an out-of-the-money options contract with a strict expiration or liquidation boundary. Because a single attempt is highly susceptible to short-term negative market variance, your personal capital must be structured to fund a multi-attempt campaign. The Monte Carlo data demonstrates that while a stellar strategy may only have a 60% probability of passing a single evaluation due to path-dependent rules, the cumulative probability of passing at least once over a structured 3-attempt budget scales past 93%. The retail prop firm industry engineered an ecosystem where the odds are stacked heavily against human emotion and traditional retail money management. They want you aggressive, they want you leveraged, and they want you focused on a fictional 6-figure balance. When you strip away the marketing and analyze the rules through pure probability, path dependency, and risk of ruin, the illusion vanishes. Treat the evaluation as a cold math problem. Minimize your real risk. Compress your targets under trailing rules. Budget for statistical variance and force the system to pay out. Stop trading under their illusion. Implement the math. If you are ready to look past the retail marketing and build a genuinely systematic, quantitative edge, subscribe to the channel. We don't trade on hope here. We trade on mathematical reality. Stay objective. See you in the next architecture breakdown.